You guys know how much I love consensus opinions on Wall Street. And, I listen to the shows in the morning just to hear what the different talking heads are saying. And it seems like every strategist comes to the same conclusion at the same time. And I feel like what we're hearing is markets are going to go up to the end of the year, right? You typically have a Santa Claus rally. Seasonality is really good. But then sometime in January, you're going to get a sell-off. People are going to be repositioning their portfolios. You're going to get a nice correction. And then markets are going to go up from there again. It's just like such a neat narrative that, Bob, I 100% believe it's not going to happen.
Are you talking about the same people that this time last year predicted the S&P might reach 4,500 this year, Rye? And now we're at 6,100? Are these the same people you're talking about that are predicting the short-term moves in the market over the next 6 weeks?
Well, I think what happens here too is there's this feeling of like you always have to play it safe, right? Like you always have to have some powder dry to take advantage of this imminent dip that's going to happen, which never comes. And I think right now it's more dangerous than ever because we know the animal spirits are out now, right? People are becoming less optimistic, more euphoric, depending on what market you're talking about. And when everybody believes that things are going to be good, and right now, if you look at the optimism for what the market's going to do next year, like everyone believes markets are going to go up next year. So maybe they won't. I don't know. No one's going to be selling right now. If anything, there's going to be more money pouring in. So I think your bigger risk, which we talk about a lot here, is I think you got a big melt up that you might see here. And I think it might already be happening.
I feel like when I went to bed at the end of October last year, everybody wanted to be more conservative. And then, when I woke up this year, now everybody wants to take more risk. And I just can't figure out what happened.
Yeah, I know. It's just, you see the wisdom of a financial plan, right? How about achieving your goals with the least amount of risk and as much certainty as we can provide? I mean, it's such common sense, such a common sense approach. But again, that whole concept of enough comes into play. When do you have enough?
I'm bored already, Bob. You know what? That's financial planning tied to your goals. Come on. Right now, I can buy a double leverage ETF for that company MicroStrategy, which just owns Bitcoin, which is leverage on the leverage. That sounds like a good time to me. That's where I'm putting my money. But no. And I think in all seriousness right now, I always think about that Warren Buffett quote is always be fearful when others are greedy. And I think right now more than ever, you just don't know when that music's going to stop. And we're seeing it everywhere right now. Every sentiment indicator is that ultra optimism right now. You've got all these crazy irrational investments like Bitcoin, crypto, and you're just starting to see valuations in a lot of parts of the market that are just starting to get where they're historically very expensive. These are signs to be more cautious, not like caution to the wind.
Well, I spoke with somebody today and they told me that we should own crypto because we need some hedges against inflation in our portfolio. And I politely reminded them that when inflation hit back in 2022, crypto went from 67,000 to 16,000.
Well, I don't know. Does it give you pause when the smartest and wealthiest investor of our lifetime doesn't have a dime in crypto and is right now sitting with $300 billion in cash? I think, what do you think? Maybe he's lost it?
Maybe, but Warren Buffett is the smartest investor of all time. So maybe he knows what he's doing. There might be some wisdom in there. But, I think what it comes down to is we're talking about this AI thing like it's the greatest thing since sliced bread. I mean, when you get down to it, all technological advances, whether it was the internet, it's this AI revolution, is just our ability to process data at a much quicker rate, right? Back when the internet came into vogue, I had just started my career, worked for a .com company, and it was amazing to be able to send emails, right, Bob? I remember back in the day, you would have a stack of letters, and your goal was to get through all that paperwork every day, respond to all the letters, send whatever you had to send in the mail, and all of a sudden, we're doing this instantaneously with email. So the productivity went up astronomically, and I'd argue AI is kind of the same thing, right? We're just processing data quicker, which makes everything more efficient.
Wait a second. Hold up, Rye. I think Dad still prints out all of his statements on that perforated printer paper, and he still goes through with the highlight all the clients that have cash.
Well, sometimes the old school works better than new school, Chris, is what I've read.
That's why nothing falls through the cracks, guys. But that's a great point because now it's just like every other technological innovation, right? It's everybody benefits. Every company's a technology company. And that's why it's so smart to stay invested, but to spread out your risk, to make sure you're diversifying your portfolio, because there's a lot of companies. Remember, every company's a technology company now. Every company's going to benefit from artificial intelligence. I mean, there was a great article in Barron's just 2 weeks ago about how the oil industry has been, benefiting from technology. Over the last 10 years, they're drilling 40% more oil a day, or 60% more oil a day, guys, with 40% less people. So the productivity in the oil industry is going up because of technology. Now, it's not necessarily AI, it's just advanced technology.
Yeah.
It gets better all the time.
Well, Bob, the antithesis of drill, baby, drill. They're actually producing more oil with less drilling, right? Ironically. And they went from their profit margins they had to be at $90 a barrel in 2012 to be profitable. Now it's down to somewhere in the 40s. So when you start thinking about that, oil doesn't even have to go higher because they're just going to become more efficient. And I think that's the point here is, look, the economy is clearly heating up, right? If you start looking at economic growth, much higher than we saw last decade, and regulations are probably going to be less than they were in the last couple of years. I'm going to just put my head out there on a limb. And, also we know that there's probably some tax cuts coming, and the animal spirits are out, but, just blindly buying an index like the S&P 500 or anything that's the picks and shovels of AI, whether it's NVIDIA, Microsoft, Amazon, whatever, you're not really going to benefit from this huge AI revolution that's going to basically benefit the entire economy. And that's why you want to spread out your money.
Well, guys, in the long run, we all make money. But in the long run, the only way you make money in the market is to stay invested. And there's always this belief when we're in a speculative phase that you're going to be able to get out right before it tops, or somebody's going to tell you, that we hit a top. It's that, I guess, that old expression, like you're in the ballroom and you're going to get out before the clock strikes midnight, except for the clock has no hands. So, the only way I find to really take advantage of the opportunities the markets provide is to have a targeted allocation, is to have specific percentages. Because when that market drops and the opportunity presents itself, you're going to panic if you're already taking too much risk. If you're balancing your portfolio, you're going to be smart about it.
I don't know about that, Dad. Back when the Fed lowered rates for the first time this year, Ryan told me that emerging markets were going to move up 6% in a day. But he told me after it happened.
Yeah, a lot of money. That's the problem. There's a lot of Monday morning quarterbacks. And the irony is, the data could be getting better and better after the market sells off, right? We saw this back in 2000. Like Cisco's earnings were still improving when that stock actually started to go the other way or started going down. So, the news is not going to be ahead of the market. That's one thing we've learned historically. And we all think that's going to be the case, right? We're going to be able to read the tea leaves ahead of time. There's going to be some indicators. Typically, the market's going to be ahead of the data. That's why you want your portfolio to be ahead of the data as well. Don't wait. The party's happening right now. Diversify before the party's over, because Bob's not going to tell you when it ends. Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, it's the tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And Bob and Chris, I thought we'd go old school today and do a spotlight segment. We haven't done one of these in a while. This is where we take a real case, something we worked on here at Payne Capital Management, and we just talk about the different pitfalls and mistakes an individual or a couple made with their retirement planning, how we fixed it to help our listeners do the same with their own financial independence plan. And Chris, you worked on a case recently, a really good one. Why don't you break it down for us?
Well, it's this is a classic example. This is a couple that are in their early 70s. They're retired. They did it right. They worked for one company for their entire career, saved way more than they spent, and built just an absolutely enormous nest egg. The problem is that they're taking way too much risk. They're invested like you and I are, Rye, at this point in their lives. They don't need to be. And they also had some estate planning issues.
Yeah, well, I looked over the comparison that you put together, and I think you said this couple's in their early 70s, and they're like almost 80% at risk in the stock market. Now, it's great when that stock market's going up, but if you're in your 70s, and rumor has it, guys, the stock market doesn't go up every year, and you get a big downturn, like this portfolio, for lack of a better way to put it, it's going to get destroyed, which is a horrible place to be in retirement. And I'm curious, Chris, did they realize they even had this type of risk until you put this comparison together?
I think they understood it peripherally, Rye, but I actually showed them a back test of what would have happened to their portfolio in 2008 and would have been down almost 50%.
Wow.
Well, what about 2000, Chris?
I didn't run it back to 2000, but I'm sure it wouldn't just as much.
So if you're down 2000, you're down 50%, and then you're down 2008, down 50%. Does that mean you have zero left?
We'll never know, Bob.
It just goes to show you how the market can break your heart, right? It took 7 years for you to get back to even, and then the market smacks you in the face again. I know a lot of people are really brave now because the market's going up for a whole year. Remember this time last year we had a big correction, but we lived through this, right? We lived through 50% corrections in 7 years, and I'll tell you what, I didn't meet anybody that was brave.
Yeah, no, and I think that's the problem. Is I think people don't realize how brave they're being. We had to be honest about it. Like this couple probably doesn't realize the underlying risk they have in their portfolio. And I love you to hear, Chris, you mapped out, they have a lot of different mutual funds and different accounts, and you put them all in one place. And you start looking through the different funds that they own, and it owns all the same names, right? They own the S&P 500 fund, the total markets stock market fund. They all have different titles, but if you break down the actual portfolios, they're all heavily weighted to those Magnificent Seven stocks or AI related stocks, which is great when they're going up. But the problem is you have that concentrated risk. What if at some point they go down, you have nowhere to hide? And so many portfolios look like this right now.
Yeah, exactly. It's like, all these fund names, they're clouded in these like really fancy names. They make them sound very unique. But to your point, at the end of the day, they all own the same stuff. So it's kind of like the old adage, you live by the sword, you die by the sword. If any of that stuff goes down, it's dragging down the performance of the entire portfolio.
So Chris, when you have a joint account relationship, my experience has been there's always one spouse who is the decision maker, who is the one who's interested in the financial part of the equation, who actually has some understanding of what they own and maybe why they own it. What's the situation here? Are both spouses involved, or is one spouse making all the calls?
No, it's just like any other relationship that we have. One person's involved, one person's making the decision, whereas the other spouse, for lack of a better word, could care less.
Yeah. So what happens when that other spouse, the decision maker, passes? What's the accommodation? Is that person supposed to fully understand why they were taking all that risk?
Yeah, like one of the things that we found when we had their estate docs reviewed was that they're missing out on a big tax credit. So in other words, if the second spouse dies, effectively because they're not taking advantage of the state tax credit, they're going to pay almost $1 million in unnecessary taxes.
Yeah, tithing your assets, depending on where you live, is so critical. And most of us probably haven't to update our estate plan in years. So it's one of those items that kind of gets forgotten or doesn't want to be addressed. But clearly, like just retitling things correctly, having some money go into trust as opposed to the other spouse's name, depending on the state specifically, can have a huge impact on how much estate tax is paid. The other thing too, Chris, is interesting to me is it looks like they've saved a lot here for retirement. And I'm going to guess their goal not only is their lifestyle intact, but leaving a legacy for their kids and their grandkids. And that's where, like, as Bob likes to say, you want to avoid as much government partnership as possible, which is such a nice way of saying, Bob, keep away from the tax man.
Yeah, right. You make a really good point. One of the things that was really important to them is not just making sure that they're financially independent, but also making sure that their kids are set up and their grandkids. So, really they're trying to create some generational wealth. And the fact that they were going to miss out on almost $1 million in taxes in that government partnership, that was pretty upsetting to them.
Well, I find it interesting. A lot of people, they don't understand the concept of enough. They think they do, right? Until you run the financial plan. And, it's in a lot of cases like, well, we have 10 million, but now I want 20 million. So it's sometimes, I want more than enough, or I want to create generational wealth. When they create generational wealth, why don't I create multi-generational wealth? So I think in a lot of cases, when things are going well, we tend to move the goalposts as opposed
Bob,
to planting the flag of success.
well, it kind of reminds me of Chris, kind of a microcosm of that, right? Every time he gets a new boat, he's always on to getting a new boat. So, there's no one I've ever met that's always got a new fancier catamaran than Chris. But the other thing to think about here too is just talking about managing the risk. Like, obviously they don't need a lot of risk. They're trying to transfer some of this wealth to their heirs as well. But Chris, I want to use one of your favorite sayings is you get a better outcome with income. And for a couple that's retired living off their portfolio, they're very dependent on if the market goes up or down. And there's not a lot of income being generated on this portfolio. And again, you do that comparison and you just show them how much more income they could generate if they reposition their assets more conservatively and managing the risk much better.
Yeah, I mean, it's a substantial increase. It's more than going to cover what they need for their lifestyle, and then also the gifting that they're doing for their kids. And you're taking about 40% less risk. I mean, in my mind, it's a no-brainer. The biggest objection they have at this point is the fact that they would have to pay some taxes. But if you think about where the market went in 2008, how much they could potentially lose in another big crash, it's really just a drop in the bucket.
Well, there's two ways of fixing it, right? You can take the gains and pay the tax, or you can wait till the market crashes and let the market, take the gains away. And then you feel really good because you didn't pay the tax, right? It's like the old joke before the 2008 crash. He said, hey, I got divorced. I lost half, but I didn't have to pay any taxes. So it's like,
that's a bad strategy. And the other thing too, Chris, just putting a number on it is by just repositioning this portfolio, you're able to generate another $150,000 a year in income. And we know income is very consistent, right? We know almost at the beginning of the year exactly what kind of income is going to come in on a portfolio like this. Like, why not build that kind of certainty into your retirement? Why have the anxiety of wondering what your portfolio is going to do on a daily basis, just because it's really beholden to the ups and downs of the stock market? And I think, everyone now who's getting close to retirement or retired now, you have to start thinking about your portfolio in a different way. It's that wealth distribution plan versus the wealth accumulation plan. It's like fine when you're 30 or 40. We talk about this all the time. They have all those fluctuations because you can make it back, but you can't make it back when you get into your golden years. And I think it's a huge mistake we're seeing a lot of baby boomers making right now with their money.
So, Chris, it's really a classic case, right? I mean, I find a lot of times, even though you think you might have the best estate planning attorney, but I'm finding even estate attorneys have their own prejudice towards doing certain things, right? They, a lot of times they don't like to title assets a certain way, and they don't keep up with, the way things are transitioning in the tax law. So I think it's critical to have a financial advisor, a planner who's looking at these issues every year. In this case, they didn't have their estate plan, wasn't up to date, and their attorney didn't update it for them. And when you have a portfolio that goes up in value, as you get more wealth created in your portfolio, as things go up, the risk doesn't go down, right? As prices go up, the risk increases. And I think it's pretty clear here that these people are benefiting from having met Chris Payne.
I couldn't agree more, Bob.
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob. Andy Warhol, known for finding artistic inspiration in Campbell's soup and Heinz ketchup, once sculpted boxes of steel wool scrub pads, was actually purchased for $1,000 in 1969, ended up fetching more than $3 million at a Christie's auction in 2010. That gain works out to be a compounded average return of 21% a year versus the S&P 500's 10% a year. Bob, is it time to start buying art and forget buying stocks?
Well, I was thinking about starting an ETF that invested only in fine art, but it's kind of hard to raise the money to buy art at the price it's at. But you never wonder, guys, all the art you have hanging in your houses and we have hanging in the offices, can we resell that? Has that gone up at all? I don't think so.
I think in a lot of cases, the frames might be worth more than the actual art. And as a matter of fact, I heard a story about a billionaire who had one of those steel wool boxes that Andy Warhol designed on a super yacht. And one of the stewards thought it was trash and threw it out.
Well, that was a bad financial decision.
Well, they thought it was trash, and the billionaire thought it was treasure.
You know what would have been worse, Chris, if his Bitcoin wallet was in the box.
When the illusion becomes real, gentlemen.
Yes.
That's right. If that's the case, I got some tulips I want to sell.
All right, Chris, China has become more competitive. Its global trade share is at a record 17%, above when Trump was first elected. Chinese 2023 market share in global car production, up from 1.4% in 1998, is now up to 38.4%. Man, oh man, those Chinese have just slowly been taking over trade.
Well, you'd never really know it because I've never seen a Chinese car in the U.S., and I'm pretty sure we're not selling a lot of Fords over there either.
Well, Bob's hoping we keep those tariffs high. We'll never see Bob in a Chinese car.
Hey, never say never.
Okay, fair enough. All right, Bob, just over half of the 900 people aged 18 to 54 surveyed said they had purchased a holiday gift because it was recommended by an influencer on social media, according to a December 3rd press release by the Influencer Marketing Factory. Social media platforms were the top source of holiday gift inspiration at 30%, followed by recommendations from friends and family at 24%, and advertisements, good old-fashioned advertisements, 21%.
Well, I don't know. I think if you're a social influencer and you're pushing a product, chances are you're getting a kickback from that product. So how's that not advertising?
I guess it's more like stealth advertising, Bob. What can I tell you?
Yeah, they're always sneaky about that.
Yeah, well, it's kind of like Ryan. You become quite the influencer. Just kind of wonder who's paying you to promote what products.
I'm pushing Bob Coin all the time. And if you buy today, you get a free set of steak knives.
You know, Chris, I did notice when I was in your apartment the other day that you had a lot of Taylor Swift on based on Ryan's recommendations.
I follow Ryan's Spotify playlist religiously.
A lot of Taylor Swift and a lot of Beyonce. What can I tell you? All right. Another great episode of the Payne Points of Wealth podcast. Hope you enjoyed episode 186. If you like our podcast, love our podcast, you can give us a 5-star rating on iTunes, Spotify. You can subscribe. If you're watching this on YouTube right now, please give us a like. You can subscribe to our channel. Click that notification bell to be updated every week of all our new content. Your support gives us the support to continue to do this podcast. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.